Drawing on liquidity refers to the practice of accessing available funds or assets in a financial system to meet immediate needs, obligations, or opportunities. Liquidity represents how quickly and easily an asset can be converted into cash without significant loss of value. In financial markets, liquidity is crucial for businesses, traders, and institutions to ensure smooth operations and handle unexpected demands. In simple terms, drawing on liquidity means tapping into cash reserves or liquid assets to fulfill short-term financial requirements. For example, a company might draw on liquidity from its cash reserves or a credit line to cover operational expenses, pay suppliers, or seize a business opportunity. Similarly, an investor might liquidate a portion of their portfolio to free up cash for other investments or emergencies. A common source of liquidity is a line of credit, such as a business credit line or personal credit card. For instance, a small business experiencing a temporary cash flow gap might draw on its credit line to pay employee salaries, with the plan to repay the borrowed amount once customer payments are received. In the context of trading and financial markets, liquidity refers to the ability to quickly buy or sell assets without causing significant price fluctuations. Traders often draw on liquidity in the market when executing large transactions. For example, a trader wanting to sell 1,000 shares of a stock will rely on market liquidity to execute the sale at or near the current market price. If the market lacks liquidity, the transaction may take longer, or the trader might have to accept a lower price. Central banks and governments also play a role in liquidity management. For instance, during economic crises, central banks might inject liquidity into the financial system by lowering interest rates or purchasing assets like government bonds. This allows banks and businesses to access cash more easily, stabilizing the economy. A recent example is the COVID-19 pandemic, where central banks worldwide introduced measures to ensure liquidity so businesses and individuals could meet their financial needs during uncertain times. The importance of liquidity becomes evident in situations like a liquidity crunch, where there isn't enough cash or liquid assets available to meet demands. This can lead to financial instability, forcing companies to sell assets at discounted prices or even default on obligations. To avoid such scenarios, businesses and individuals often maintain emergency funds or access to credit facilities as a liquidity safety net. For example, a family might keep an emergency savings account to draw on liquidity in case of unexpected expenses, such as medical bills or home repairs. Similarly, businesses might hold cash reserves or invest in short-term instruments like money market funds, which can be easily liquidated when needed.